My key takeaway is what the Fed is saying without saying is that we're in for stagflation, and makes me nervous because to say we're in for stagflation, the obvious corollary is so that's good for gold and silver. But with gold over $4,000 and silver close to 50, and I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever, that I'm not predicting like gold's going to the moon. But it's striking to me that we're heading into an environment that should be bullish from gold, and we're heading into it from a level from 4,000. That's kind of exciting. The price to borrow silver in London to meet physical demand, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve this. But I like this because silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend. And that's good for the longevity of this market. You have more time for all of us to make money here. As consolidation goes, the more confidence I will have that the next big move will be up, not down. Honestly, the next big move could still be down.
Stagflation is emerging as a defining force in the current economic landscape, reshaping expectations for precious metals as policymakers quietly prepare the public for slower growth paired with persistent inflation. Even with gold holding above meaningful structural levels and silver stabilizing near significant psychological thresholds, the combination of sticky prices, weakening economic signals, and the Fed's reluctance to raise rates is generating a powerful backdrop for tangible assets. Market behavior suggests that strong hands are treating every consolidation phase as confirmation of long-term strength rather than a sign of exhaustion, preserving momentum even after rapid advances. Lobo Tiggre, a respected macro analyst in the metals space, emphasizes that this environment resembles historical periods in which monetary misalignment fueled multi-year expansions in hard assets. His broader view points toward the durability of the trend rather than short-term reactions, noting that extended consolidation phases often precede the next major upward leg. As inflation pressures remain unresolved and policy responses tilt toward future easing, the market may be setting the stage for a renewed cycle of capital rotation. Now, we present the clips from Lobo Tiggre's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The fact is, inflation has been going the wrong way for 6 months. It's 50% above target, whereas unemployment is supposedly at record lows or near record lows, and they're cutting. So, if of the dual mandates, if one is 50% above target and one is not a problem, why are they cutting? What are they not telling us? I think that's not a conspiracy theory. I think that's a reasonable question to ask.
Pragmatic thinking.
Clearly, there's more weakness there than they're willing to let on. And another thing that they're not saying is transitory. But clearly, they either think the inflation is transitory, because they're not acting on it, or they know it's not, but maybe they're not worried about it going too much higher. They know it's not going away, but basically 3% is the new 2%, right? They know it's not going away, but they don't think it's going to get much worse, so they're erring on the side. But either way, what we end up with is weaker economy, high inflation, above target, stagflation. And we all know, what happened the last time we had a serious bout of intractable stagflation in the U.S. And by the way, sorry to interrupt myself here, but people often say, Lobo, you talk about the U.S., the Fed, so much. The world is global. Gold is a global market. Well, but we tend to quote the price of it in dollars. The gold-dollar exchange rate, I like to call it. So what happens with U.S. policy to the U.S. economy, the U.S. dollar, is relevant not just to gold, but to all commodities. And it's also the world's largest economy. So it's not irrelevant, even if you live in Switzerland or Shanghai, to pay attention to what's going on in the U.S. So anyway, my key takeaway is what the Fed is saying without saying is that we're in for stagflation. Makes me nervous because to say we're in for stagflation, the obvious corollary is so that's good for gold and silver. But with gold over $4,000 and silver close to 50,
how much better can it get?
Right, and I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever. And I'm not saying they're wrong. It just makes me a little nervous because we had a hockey stick from 2,500 up to 3,000. We waffled a bit, and then we got another hockey stick. So if it hockey sticks again, that's 3 in a row. That's a pretty tall ask. I'm not saying it can't happen. Could be the stagflation story kicks in, and we end up with, Goldbug's dream come true, right? The next blow off top. Though, honestly, and I'll let you go with the next question here, I would much rather see actually a period of consolidation. I think that would be healthy, and it would give me greater confidence in the longevity of this gold bull. Whereas if we go right away into that blow off top, so don't forget to take profits. If you're going to go from QT to QE again, at some point you have to go to zero. The rate of change, at that inflection point has to go to zero. So the takeaway from here might be that what the Fed is actually signaling is that they're worried enough about the weakness they're not acknowledging that they're setting the table, priming the pump for QE, which would, again, that's inflationary, would be obviously bullish for anything real, including monetary metals. So that I'm not predicting like gold's going to the moon, but it's striking to me that we're heading into an environment that should be bullish from gold, and we're heading into it from a level from 4,000. That's kind of exciting. This is the equivalent of me pounding the table, I guess. I try not to do that, right? But one more thing on this.
Yeah.
It's really interesting to me that gold is doing that beach ball thing. Like it's gone under 4,000 and it just keeps coming back up again. And when gold hit almost 4,400, right, and then rolled over and it started going down, it was reasonable to say, where's the floor, right? And a reasonable, at least psychological, if not technical level would have been 4,000. Does it hold 4,000? Because if it kept going down through that, the technical guys would say your next Fibonacci is like 37 and change or something. That would be a significant pullback, or a much bigger one than we've got now. Almost officially a bear market, right? So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, and then what happened? It went up to the next big leg up. So the longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. Right now, honestly, the next big move could still be down.
Yeah.
Christopher Mullen, who is, I think his morning talk this morning was actually pretty bullish on that basis. And I can't say more,
okay.
He's the expert, not me, looking at like how long, we consolidated for a couple years over 2,000 and it dropped pretty low, like 1,700, what it was, I forget what the low was after 2,000. Lower than 17. Anyway, consolidated for years, but waffled around that range. And then it did the same thing for less time over 3. And if it does the same thing now, I don't think we'd have to wait that long, because you've got the central bank buying, you've got mainstream waking up to gold, gold being a crowded trade this year, on Main Street at least, sorry, not Main Street, on Wall Street at least, a crowded trade. So the ingredients are there for a real flavor of the day, like the kind of market mania that happened in the late 1970s and 1980, which didn't really happen in 2011. Like, the shoe shine boy giving you gold stock tips and stuff. That didn't happen in 2011.
Silver's behavior in the current market cycle highlights how closely it is now linked to industrial demand, structural shortages, and physical market pressures that differ from traditional monetary drivers. The recent surge in borrowing costs to secure metal in key hubs, along with the logistical adjustments required to meet delivery needs, demonstrates just how scarce the available supply has become. Even with periodic pullbacks, silver returning closer to trend rather than accelerating far ahead of gold helps reinforce the durability of the broader bull phase. Consolidation at elevated levels supports the view that this cycle still has room to run, giving investors the potential for extended participation rather than a premature blow-off peak strength in underlying fundamentals, ranging from technology infrastructure to global electrification, continues to support the long-term thesis. At the same time, the tightness in above-ground inventories signals that future disruptions could amplify upward momentum. Let's get back to the interview.
Silver's always been more volatile than gold. It also, though, has, I think undeniably, people call me Darth because of my saying, though, but I think it undeniably has a much stronger response in price to its industrial side. It's always had an industrial side, like it was photography before, now it's electronics and solar panels. But it's always had an industrial side. But that is clearly a stronger variable now. Like it really affects the above ground available stock in a way that doesn't matter for gold. So that's interesting to me. But I'm actually not even, that's not even where my head is on that. I do think that the thing I'm watching is that even your most diehard silver uber bulls will tell you that silver lags at first, but it's okay, don't worry, because silver always catches up at the end, more than catches up at the end. Fine, I agree. Historically, this happened 9 out of 10 times. But if we're in the catching up at the end phase, that implies that we're in the end phase, right? And I don't think that's true. So it was concerning me that silver recently was screaming north faster than gold was. But we have a proximal cause for this: the squeeze, the physical squeeze in London. The price to borrow silver in London to meet physical demand, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve this. But I like this because silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend. And that's good for the longevity of this market. You have more time for all of us to make money here. And this is an important point. My job, what my clients pay me for, is to help them make money, not to be ideological or religious about defending silver or gold or uranium or whatever it is. So don't get mad at me if I talk about taking profits or markets going up and down. The purpose is not to be a cheerleader for your favorite commodity. The purpose is to make money. And we make more money, I think, if we have years to go in this bull market, which ultimately takes us higher than if we get a blow off top now and then we have a bear market for years. Right? So silver accelerating was worrisome because it might have signaled the end of the market. And silver correcting more right now brings it back to trend, and for me, that's a sigh of relief. The bull in monetary metals is stronger this way. One kind of nervousness is this is it, the market is done, we got to get out. And there's nervousness of, it's gone really high and maybe it's time to lock in some gains and things. And it's quite different. And this is why I think the beach ball thing with $4,000 gold is so important, because if it was the nervousness that, like this is a nosebleed valuation, it's irrational, it's got to pop and then go into a bust mode, which we could say about other markets today, maybe. If that's the nervousness that we had, I don't think gold would have stopped at 4,000. I mean, I think it would have blown through the Fibonacci and easily gone back to 3,000. Maybe even lower. That didn't happen, or at least hasn't yet. That's why I say the longer we consolidate here, the less I worry about that. Whereas the nervousness that, this is faster than we expected, clearly that there was a yes there. There were people who were ready to lock in gains the moment it seemed like things rolled over. And by the way, I was one of those.
Fair enough.
And you can hate me if you want, but it wasn't just me. Our good friend Rick Rule, on recent interviews, he's mentioned reaching the point of no concern, as he calls it. And this is actually an important point. It's not like Rick is now bearish on gold and silver, nor am I. And it's not like he's completely out of the markets. He's just sold enough that he has no risk, like he can't lose. I've sold enough that I've actually locked in gains. So I can't, not only can I not lose, I can't not make money. And I've made enough that I actually still have enough left on the table that if the next big move is up, I still make even more money. And by the way, I paid down my mortgage. I mentioned that in terms of keeping things real. I'm not betraying the cause of silver or gold or something. I'm just saying, it went way up. I had a lot of money unrealized. Like the EV thing, that's not why copper's up. I mean, that has helped, but it's not the base case. The base case is we call it Dr. Copper. It's because it's a fundamental metal that's needed like steel or aluminum for many, many things. So the electric car thing is a tailwind on top of that demand. So is the AI thing. It's like even if the AI turns out to be completely overblown and the whole thing, simmers down, that doesn't hurt the copper demand scenario, like the actual copper demand scenario. But by the way, I think even if the companies are overhyped and the share prices are overhyped, the reality is those fabs are being built, right? And the data centers are being built. And a lot of other infrastructure around this whole thing are being built. And I'm just a mining stock analyst, but for whatever it's worth, I think the United States, Russia, and China, maybe Europe too, but at the least those three are in an arms race over AI. I think, and Putin has said that whoever gets to super AGI first wins World War III. So, for whatever it's worth, I think the powers that be get that. It seems pretty clear to me if you look at what Trump is doing, he gets it too. Nobody wants to be last on this. This implies a massive investment, which is extremely bullish, really all critical minerals, including copper. So the demand case, I think, is spectacular. Like the worst case is growth, and then you add the EVs or the AI on top of that, and you get super growth. Meanwhile, the supply side is extremely constrained. It takes forever to permit these things and build the mines, and finding them, those are very, very few and far between. Like world-class discoveries, it's been maybe 2 in the last decade. Both of those were sort of already known assets that just turned out to be much bigger and better than we thought. And meanwhile, you keep having problems on the ground. And I don't just mean like Cobre Panama, but just mine accidents. Unfortunately, this year we've had 4 major mine accidents, including with fatalities, and that's not good, but it just shows you how difficult it is to ramp up supply. So extremely bullish. And I like uranium for similar reasons. I don't know if you're going to ask about that, but the thing about uranium is that it is possible. I think it's very unlikely, I don't worry about it, but it is always possible for there to be a nuclear accident that tanks the stocks. That's not possible in the copper space. There is no copper reactor that's going to cause a global scare. So I like them both. There's a meltdown scenario in one and not the other, and that predisposes me to the other. Also, uranium at $80 plus arguably is near the incentive price, so there's less of a squeeze I feel there, whereas I feel more upside on the copper space. And one more thing, when I say my highest conviction trade is X, that doesn't mean I think X is going to be the metal that goes up the most. You get, by highest confidence, I mean that I see significant upside, and I see it as most likely, right? So it's that combination. So arguably you could say, gee, Lobo, copper was your top pick for 25, and platinum was up more, gold was up more, silver was up more. That was a terrible call. Well, copper, that slouch is up 25%. That's not bad,
No.
right? And I won't rehash everything. There are reasons for that, but most of the reasons why I'm bullish on copper are still actually in front of us. Copper was up this year, and a lot of that had to do with Trump shenanigans, right? Tariffs, no tariffs. Yes, you're right. Copper on, screeching north and then south again. So all of my reasons for bullishness are still largely in front of us. So I'm very keen on that space.
Cool.
Silver's position in the current macro cycle is becoming increasingly defined by the widening gap between physical availability and financial market expectations. While monetary metals often trade in tandem, the industrial footprint of silver across energy transition technologies, high-end electronics, and critical infrastructure has intensified its role within broader global supply chains. The market's latest behavior reflects that reality. A surge in physical premiums, rapid shifts in borrowing costs, and the movement of metal across major hubs all signal a market operating under genuine strain. Despite episodes of sharp enthusiasm, the metal has now eased back toward a more sustainable trend, reinforcing the health and longevity of this bull phase rather than indicating exhaustion. This return to balance is significant because it allows underlying structural drivers, tight mine supply, expanding use cases, and intensifying geopolitical competition for critical minerals to take center stage without the destabilizing effect of runaway short-term speculation. Within this environment, consolidation in gold at elevated levels adds additional support. Precious metals are behaving less like risk assets and more like essential hedges as macro pressures strengthen across inflation, monetary policy, and sovereign balance sheet fragility. The repeated ability of gold to absorb selling and reassert its footing above key thresholds Silver benefits from this stability while retaining its own asymmetric potential due to persistent structural shortages and limited capacity for rapid supply growth. As technological and geopolitical catalysts continue to converge, the foundation for a durable multi-year advance remains firmly in place, giving investors time to position themselves rather than chasing parabolic moves. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.